we did a research project asking, has value in fact died? Has it died? Are the critics right?
So Rob, I do want to get on and talk about research affiliates and the products you have on offer. But before we do that, we've spoken about growth versus value before, and myself included, there was many of us who felt that growth had had its time in the sun, and with higher rates, this was going to be a period for value to outperform. We have got the high rates. It appears they are going to be here for a while, but still there's a lot of tailwinds in growth. I'm just wondering if I could...
Very narrow sliver of growth. Big players, but small number of names.
So actually what we're doing there is we're talking about growth as a whole, but it's just a handful of the Nvidias of this world that are just taking that whole segment of the market with them.
I read the other day that the 5 most successful stocks this year in the S&P were the only reason it's up year to date.
Is that right? I haven't seen that maths before, but that might be right. Yeah. to
value went through the longest and deepest dry spell in history from 2007 to summer of 2020. Depends how you define value. If you define it on price to book, it was that full 13 years. If you use price earnings, it was from 2013 to 20. If you use price to sales, 2017 to 20. Either way, it's a long dry spell, and the 2018 to 20 period can only be described as a value crash. Value underperforms severely. Now, as a value investor, obviously that puts our company through a ringer, and it has us challenging and testing our own assumptions. So we wrote a paper back at the beginning of 2021 in the FAJ. It got Graham and Dodd recognition as one of the 2 best articles of the year. Oh, wow. The paper was entitled "Reports of Value's Death May Have Been Greatly Exaggerated." The basis of the paper was we did a research project asking, has value in fact died? Has it died? Are the critics right? And what we looked at, among other things, was the spread in valuation between growth stocks and value stocks. Now, if you use a classic Fama-French formulation, you're using price to book. And in 2007, the spread in price to book between the growth stocks and the value stocks, using Russell Growth and Russell Value, for instance, was 4-1. Growth stocks are more expensive. They're better companies, and they deserve a premium multiple. But how much of a premium is the key issue? That went to 13-1 by the summer of 2020. It only reached 10-1 at the peak of the tech bubble. So this was tech bubble on steroids, magnified. Now, what's interesting is that Russell Value, peak to trough, underperformed Russell Growth in terms of relative performance by 3,700 basis points over that 13-year span. Russell Value got cheaper relative to Russell Growth by 3-1. So if it's down 67% in relative cheapness and down 37% in relative performance, then that means the underlying fundamentals have actually been improving relative to growth. I'm actually going to show an exhibit that shows this vividly. The dividend stream of a Russell Value portfolio from 2007 to 2022 has risen faster than the dividend stream of a Russell Growth portfolio.
Really?
And it's not because the value stocks grow faster. It's because of what Fama and French called the migration effect. Value stocks, the value portfolio, you have individual stocks that percolate out of it, suddenly get recognized as, oh, this company's not so bad after all. They're kicked out and replaced with deep value stocks. So if you replace a stock with an earnings yield of 5, PE ratio of 20, with one that's earnings yield of 10, PE ratio of 10, then you're boosting the earnings base. You're boosting the dividends base, the book value base, every time you rebalance. It's called a migration effect because it relates to migration in and out of the list. The growth portfolio has the opposite. Stocks that are removed from growth almost always because they've fallen to too cheap a valuation. So if you replace a stock with a PE ratio of, let's say, 15 with one with a PE ratio of 30, you're reducing the income stream, the dividends, the book value of the growth portfolio. So net of the migration effect, or inclusive of the migration effect, I should say, the dividend stream for value, the book value for their value portfolio, all grew faster than for the growth portfolio during the period of time when value was getting crushed. Which means if the relative PE ratio, relative price to book, had stayed steady for those 13 years, value would have beat growth. So we pointed this out. We also pointed out the deep flaws of using conventional book value. And the result was a pretty compelling case that value stocks were doing badly, but value companies were doing fine. Now, markets move because of narratives. The narrative was, with the COVID lockdowns, these tech companies are beautifully positioned for a world in which people work from home, in which people don't interact as readily as they used to, a world in which social interactions are going to change, the way you buy and sell goods is going to change, and the list goes on. And by the way, these bricks and mortar companies, they're toast. You're going to see rolling bankruptcies. Well, lo and behold, with stimulus checks paired with a non-permanent pandemic lockdown, we found that the value stock survived just fine. Bankruptcies in 2020 were up modestly from 2019. Shocking that it was only a modest jump.
Yeah.
And so the result was that instead of the market was saying these value companies are going to do terribly as businesses, the reality was they were doing fine. So the snapback is something that we were predicting in the paper. What we weren't predicting was the current snapback in growth year to date this year, and that's on the back of AI. The narrative today looks an awful lot to me like the narrative of the year 2000.
Right.
Back then you had internet will change the world. It's a new paradigm. Pay no attention to profits or dividends because they're irrelevant. These companies are going to take over the way we do everything. Now the narrative is that AI will do that.
Rob, if you could explain to me the partnership products you have with FTSE and with FTSE Russell and RAFI.
FTSE embraced the fundamental index concept way back in 2005. We brought the idea to FTSE at the suggestion of CalPERS. CalPERS wanted to embrace the idea. FTSE was the index provider for CalPERS. And so obviously we had high odds of a near-term immediate client. So FTSE embraced the idea, ran with it, and it became a major profit engine. Russell came to us and said, we're going to launch similar product. Do you want to work with us on it? And my original agreement with FTSE had given a 3-year exclusive. This was 6 years in, so I said, sure. But it has to be different. They initially wanted it to be a clone, and I said, no way. So we created a complementary, somewhat different, but think of it as first cousins. FTSE, of course, bought Russell, and so now they're all under one roof. So you have FTSE RAFI and Russell RAFI, and upwards of 100 billion managed using them.
I'm right in saying performance has been pretty great since COVID.
Not since COVID, since the launch of RAFI. To the casual observer, RAFI had a challenging decade in the 2010s. But keep in mind, cap-weighted indexes studiously mirror the look and composition and performance of the stock market, by definition.
They're kind of momentum plays.
But relative to the economy, they're momentum plays, they're growth plays, they're popularity-weighted indexes.
Yeah.
RAFI is studiously neutral relative to the publicly traded macroeconomy. It weights companies according to how big is their current economic footprint right now. And so relative to the economy, cap-weighted indexes are stark growth portfolios. Relative to the market, RAFI is a stark value portfolio. So you can do a Fama French attribution and look at the alpha net of Fama French, or you could play it super simply and just say, okay, the value tilt of RAFI roughly equals that of the conventional value indexes on average over time. It's dynamic. When value is underperformed, we have a deeper value tilt than value. When value is relatively fully priced, as it was in 2007, we have a pretty skinny value tilt. But on average, about the same value tilt as value indexes. So the tracking error of RAFI Global against FTSE All World is 5%. Against All World Value, it's 2.5%. So if you look at it relative to the value indexes, what we find is since the launch of RAFI, during periods when value was winning, during periods when value was losing, during the value crash as it was happening, we beat the value indexes by an average of 1.5 to 2% per annum, now for 18 years with 2.5% volatility.
That's great.
So it's already got a T-statistic of 3+. So these indices have been stupendously effective. The challenge in the last decade has been a marketing challenge. People will inherently compare it with the cap-weighted markets. And whenever value is losing, we may be losing by less, but we're still losing.
Yeah.
When value is winning, we're winning by more, so we're perceived as heroically hitting the cover off the ball. Now, how long can that continue? If you compare it to the value indexes, you find it's just chug, 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 relentless.
Right. I have one final question. You said earlier, Rob, that you wrote a paper talking about the valuation metric price to book, how you didn't think it was such a great metric to look at. Am I right?
It's flawed. It's not,
Okay.
It's not a bad metric, but book value was defined either early 20th or late 19th century.
The reason I'm asking is I'm wondering if now, is there a better way to value stocks?
Oh, absolutely. We use a composite of measures. If you look at price to sales, price to book, price to cash flow, price to dividends plus buybacks, these are all good measures and they are all flawed. So George Box of Box-Jenkins fame was fond of remarking that all models are wrong, some models are useful. And I wish the quant community and the economics profession would embrace that. Everything we do in the quant community, everything that's done in the economics community is based on models that are wrong. But some of them are useful. So find out which ones are useful, use those. The pitfall with book value is that it leaves out all intangibles. We've all heard the cliche that our assets go up and down in the elevator every day.
Yeah.
That is true of about half of all businesses today. The old bricks and mortars businesses, a department store, it's not as true. The assets are the people for sure, but also the building and the product that they're selling.
Yeah.
And that's a big sunk cost. So book value measures that. Now, what if you take book value and when a company invests in R&D, you add it to the book value and amortize it out. If I spend $5,000 on a nice desk, it goes right on the balance sheet as an asset. It's amortized out. If I spend $5 million on R&D, it's treated in accounting land as if it was just a discretionary throwing away or burning of assets. Now, I don't spend that on R&D if I think it's going to not come back. And so think of it like a desk. Add it to the book value, amortize it out. If after 10 years it hasn't paid for itself with room to spare, then it was a dumb idea. Same as a desk you turned out not to have needed. So when you do that, Fama French price to book, the value investor today is 5 times as wealthy as the growth investor from 60 years ago. So if your grandparents bought Fama French value, their next door neighbor bought Fama French growth, you would have inherited a portfolio that's worth 5 times as much as the descendants of the next door neighbor. All right, well, that's great. If you threw in just R&D, nothing else, just R&D, you would have 10 times as much money. So price to book can be made roughly twice as effective for the long-term patient investor by incorporating R&D. You can also incorporate a portion of the administrative side to the extent that somebody spends money on patents, on brand building through advertising, and so forth. Those expenditures are justifiably treated as investments and therefore added. But that's trickier because that's all in baskets that also include ordinary operating expense. And so the one piece that is easy to carve out and say, well, this is investment, is R&D. So that was in that same paper. It really could have been 2 papers, but it was a twofer.
Yeah, well, such an important thing to discuss right now as people try to work out whether stocks are overvalued or not. Rob, it's been so fantastic chatting to you. Thank you so much for your time. It's always such a great conversation.
Well, I have thoroughly enjoyed this nearly 2-decade-long partnership, and I look forward to many years to come.
Thanks, Rob.